Assalamu Alaikum everyone, welcome back to the channel. In today's video we're going to look at 4 different stocks, 3 which are reporting their earnings next week, 1 which is basically a new addition to my own portfolio. So the first thing we're going to look at is their financial details, then we're going to look at whether they are overvalued, undervalued, and then at the end we're going to look at using Simply Safe Dividend, which is this website you see right in front of you, how safe their dividend is. They're all dividend paying companies. They're very mature companies. They're not speculative companies. So I'm going to share with you the details and hopefully see how that goes. But before we get started, can I ask you please, if you are watching this and you find any value in this video or any other videos that you've watched previously, can you just give it a like please, because that definitely helps the channel. That's all I ask for. Thank you very much. Let's now start with the first stock. So the first company that we're going to look at is Home Depot. Home Depot is reporting their earnings this Tuesday coming. The website I'm using is Seeking Alpha. So if you type HD and click earnings, you will be able to find when the earnings is coming up for that company. The EPS or earnings per share estimates, okay, is about $3. The revenue, basically, remember these are estimates. This is basically what the analysts are actually, these analysts that have actually analyzed this company are expecting. So what tends to happen is people look at this and they say, okay, oh, the company missed the estimates. These estimates come from, they come from the Wall Street analysts, and sometimes they are wrong. So if they're wrong, they're overestimated or underestimated. If they overestimate, then that means the stock goes down. If it's underestimate, then that means it's all beat and everything is perfect. Okay, so when you're looking at this, just be careful. Don't just rely too much on the estimates itself. Okay, look at the historically what the company has been doing and if they head in the right directions or not, because what you might see is a pullback as soon as basically the stock releases their earnings. Okay, so they're expecting about $34.5 billion in revenue just for this quarter, and when you look down in the last couple of quarters, you can see they missed it first, the fiscal year first quarter, and then the second and the third, and basically they have been beating it, which is really good to see. Okay, and the blues is the actual, and the consensus is basically the dark or black one. Okay, so this is basically the first company that we're going to look at today, and as you can see, they're reporting their earnings on Tuesday, I think pre-market. Now the market cap for this company is $350 billion. They're currently trading $223 per share, slightly off the 52-week high of $345 per share. The company pays dividend. The dividend is about 2% basically percent of their earnings, and when you look at that, is 2%. They actually pay you $6.60 per share. So every share you own on this company, that's how much they will pay you. Roughly that's what they will pay you quarterly. So the payout ratio, so this is how much they spend on their free cash flow, on their net income. Okay, there's about 50% of their income they actually spend paying back dividend to their to shareholders. And the 5-year growth rate is about 20%. This is probably one of the highest. Okay, you wouldn't see anything probably about 10-15. That's basically roughly what you will see, or below 10. But 20 is absolutely brilliant, and they have been doing this over the last 10 years. All right, now we're going to switch to Yahoo Finance, and we're going to click the financials. But before we do that, very quickly, you can see just everything I've showed you now. You can also find it on Yahoo summary section. But let's go to financials straight away. So when you go to the financials, you've got 3 sections: income statement, balance sheet, and the cash flow there. So we're going to scroll down and just move this across so we can see the top line here. So 100 billion, 108 billion, 110, 132. What we want to see as investors is the top line revenue is growing. Okay, the gross profit is growing. Okay, so this is how much they're spending to make this, and this is the difference between the two. So $44.8 billion in gross profit. That's amazing to see. Okay, now this is what you will then basically see for a mature company, a company that has been around for a long time and obviously have a massive product line. So 8 billion, 11, 11.2, and then $12 billion. So the net income is also growing. The EBITDA is also growing at the same time. Now let's have a look at their balance sheet. The balance sheet is where you will find whether the company is in debt or not, if they can pay their debt or not as well. Total current asset, they're about $28 billion against total current liabilities of 23. So there's no problem in the short term. They should be able to pay their dividends without any hesitation. Okay, total assets is about 70 billion against total liabilities of $67 billion. So the company is financially in a good place at the moment. When we look at the cash flow here, okay, we'll scroll down to cash flow at the bottom here. So 10 billion, 10.5, 11 billion, and then $60 million. Okay, considering last year and how things were, I mean, a lot of people were locked away in that. Because of that, actually the company made a lot more profit because people are basically renovating and doing their homes again. Okay, because that's basically this is the place to go to when you want to basically do anything to your house. Okay, so therefore they have made a lot more profit, in fact, whereas other companies haven't actually made a lot of profit last year. So you can see about $16 billion of cash flow. Now we're going to look at some of the statistics. So return on investment, things like that. Forward PE, okay, forward PE is basically forward looking. That means for the next 12 months their PE should be about 23, which is good to see. Okay, now again, profit is about 10%. Okay, profit margin, and then return on equity. I'm not sure if this is true, but I'm going to double check the return on equity, maybe use another website to double check. Final thing I'm going to do on this company is to check the analyst and see whether they think it's a buy at the moment or whether they think it's a sell. There we go. So it's a buy at the moment. That's what they're saying. They think the stock price should go up to $330. Currently trading $327. Now, I'll be honest with you. I own this company in my portfolio. I would definitely wait a pullback, maybe below 300. Okay, if there's a massive pullback, maybe 4 or 5% or something like that happens after they report their earnings, then you might be interested actually buying a couple of more shares. But at the moment, I wouldn't add to it. Okay, it's slightly overpriced, but I'll show you what simply Wall Street is saying at the moment, and that is for HD or for Home Depot, they think is overvalued about 18%. Okay, so the fair value is about 275, and I agree with that. Okay, I definitely agree with that. I started buying this company when it's $280. Okay. All right, so the next company we're going to look at is Lowe's. Lowe's is very similar to Home Depot. They also sell home products. Okay, if you want to renovate your house, that's where the tradesman goes to buy all their products, and obviously anything to do with home improvement and so on. They're reporting their earnings, I think, on Wednesday this week coming. The EPS estimates is about 2.56, and the revenue is about $23.5 billion. So hopefully we'll see how that goes. But if you look at it from the last few years, they have been beating their revenues, but this time they also are expected to beat it at the same time. But the following one, they expected it to go down a little bit. So we'll see what happens in this week anyway. So let's go to the summary overall. So this company, like I said, is the home improvement section. Market cap of $143 billion. They do pay dividend, but it's quite small. It's $1.2 billion, 1.2%. Okay, and the currently trading about $198 per share off the 215 highs at the moment. Okay, dividend is, like I said, is about 1.2. They pay you about $2.40 per share every share that you own, but they're only spending about 24% of their income, and they have been increasing this almost to 16% for the last 5 years, and they have been doing basically paying their dividend for 57 years. So don't expect any cut anytime soon because of this, and because they have been doing this, they're definitely going to carry on. So this is one of the dividend kings. Okay, right, so now we're going to look at Lowe's in using Yahoo Finance. So we're going to go to the financial section first of all. So their balance sheet, as you can see, for $68 billion, 71 billion, 72, almost to $90 billion at the moment. And when you look at their net income is also growing at the same time, which is excellent to see. EBITDA is also growing. Balance sheet, total currency is $22 billion against 18 billion dollars. Okay, so they definitely will be able to pay off any debt they have. Okay, and cash flow will be about $9 billion at the moment, and they have been growing, which is crazy because it was about almost 4 billion, then it became 5, then it went down 2020, and then it's gone up about $9 billion. So that's almost a $7 billion jump, which is really crazy to see, but I'm happy with, as a shareholder, I'm really happy with that. Okay, let's have a look at the analyst on what they're saying at the moment. So they're definitely saying is a buy at the moment. They think the share price should be about $220 per share, currently trading $198 per share. And when we look at this company in the Simply Safe dividend, they are undervalued at the moment. So they are definitely undervalued. I'm thinking maybe if there's a pullback, maybe about 2-3%, I might add a couple of more shares. I think I've got about 5 shares at the moment, but we'll see how that goes. Okay. All right, so the next company we're going to look at is CMI, or Cummins. Cummins is basically I'll show you basically what they do. So first of all, this is one of those companies that you probably haven't come across yet, okay? Because not many people on YouTube, on all the other channels, talk about this company. And when you look at the kind of products that they produce, okay, so this is the kind of products they produce. So the engines, generators, and power supplies, power systems, new powers and components. So they do all of these things for different companies. So they have a lot of, some of their clients include some of the biggest companies around the world. And sometimes some people might say, oh, these things have been, phased out, they're not going to be around for a long time. But when you click new power, you will see a lot of their new basically products. So they develop basically the power engines and the engines and things that go into these machines, these different types of vehicles. Okay, and you can see all of them are, if you look at zero emissions, for example, they're using hydrogen fuel cells, battery powered options. So they are looking for basically new and sustainable ways of obviously producing these engines, and they are a very innovative company. And if you I came across this company a long time ago, but I always thought the share price was too expensive. But I'll give you the overview anyway. If you would like to know a bit more about the company, let me know. I might do a full video on this. Okay, so let's have a look at very quickly there. So currently they trade, basically they are $38 billion company, trading about $265 per share. They do pay dividends, so about 2%. They will pay you about $5.40 per share, every share that you own. The 52-week high was about $277 and slightly off, so about $10 off at the moment. Let's have a look at their financials. Now, 20 billion, 23, 23, 19. So 2020 hasn't been a good year for them. I think it were affected. That definitely affected them. The lockdowns and all that stuff. 15 billion, again, the cost of their revenues, 17 billion dollars, then $15 billion, and then $15 million. Now, when you look at their gross profit, okay, the basically slightly declined last year, but obviously that was kind of expected. So overall net profit of $1.8 billion, and EBITDA is actually basically declined a little bit last year. So it'll be interesting to see how this one goes. But again, when you look at their total current assets, they've got about $11.9 billion against total current liabilities of $6 billion. So they have plenty of cash, plenty of money to pay off any of their debt, and their free cash flow stands at the moment as we speak about $2 billion, and it has been growing over the last few years, which is really good to see. The next thing we're going to look at the analyst and what they think about the company. And currently it's a buy, almost a buy hold, kind of in the middle. They think it should be about $287 per share, currently trading $265 per share. Now, this is what I found interesting. When I actually did look at the Simply Safe dividend, I actually thought Simply Wall Street, I actually thought this will be overvalued, but it's actually undervalued by 13%, which is very interesting to me. So I've included this in my new portfolio. They're not reporting their earnings this week, but I've included in my portfolio, and I thought this might be a good opportunity to buy a solid company that is nobody else is talking about on YouTube or Wall Street or whatever. No one else is looking at what this company. They are obviously one of the biggest companies around when it comes to this type of things. And again, I'm trying to find companies that are boring, not money, that money people are not looking at the moment, because that's where the money is at. I'm not just gonna look for the new shiny companies that are out there, because the problem is everyone, as soon as you know about a company base, that means everyone else knows about it as well. But this is one of those companies that have been around for a long time. They kind of innovating, themselves again and again. And yeah, look into it anyway. If you're interested, let me know if you would like me to do a full video. But that's kind of a snapshot of that company. The next company we're going to look at, Cisco. Cisco is reporting their earnings this week. So on the 19th of May, they're expecting about 82 cents per share. The revenue is about, at the moment, they're thinking of about $12.5 billion. And they, like I said, they are reporting their earnings this week, so you might see a pullback. I'm definitely thinking about adding this company into my portfolio, and I'll tell you the reasons why in a second. So when we look at their dividend, at the moment it's 2.8, and they pay you about $1.48 per share. They spend about 45% of their pay overall revenue. For the last 10 years, they've increased their revenue. Their 5-year growth rate was about 10%, and their dividend, they've been paying their dividend over the last 9 years. This is one of the biggest companies around. Look at their market cap. So $223 billion, and they're currently trading about $52 per share. Now, like I said to you before, I'm thinking of adding to this company on my portfolio. And the reasons for that is, look at their financials. So 48 billion, 49, 51, and then 49. So it kind of had it dipped a little bit last year because of obviously what was happening in the world. And when you look at their overall gross profit of $31 billion. $31 billion. Can you imagine that? And then you've got their net income is about $10 billion. EBITDA is also kind of declined last year, so it'll be interesting basically to see what they come up this time. When you look at their balance sheet to see if this company can pay their debt or if they have any debt. So the current total assets is $43 billion, and then you get total current liabilities of only $25 billion against $43 billion. So that's a lot. That's basically, they can literally pay off their debt easily. Final thing we're going to look at is their free cash flow here, and that stands at the moment $14 billion. So there's definitely not going to be any dividend cut anytime soon. And then analyst, let's have a look at what they're saying. Currently trading 52. They think it should be up about 54, and it's kind of buy hold at the moment. So if there's a pullback, say it goes below 45, then definitely I'm gonna buy a few shares of this company. So I'm looking maybe below 45 and see how that goes. Now let's go to Simply Wall Street. Can you imagine 41% undervalued at the moment? Okay, with a company with this type of balance sheet to actually be undervalued about 41%. Again, this is based on the analyst and what they think. So they thinking this company should be about $90, almost $90 per share. And I definitely agree with them. I absolutely agree with them. Okay, if they come up with a good quarter this time, and then obviously when they sustain that in the next couple of quarters, basically until the end of 2021, I think the price share will be about $70 to $80 per share. Because of this is not one of those. This is one of those companies that takes care of customers, basically, whether they are the enterprise or companies or whether they're actual customers. So you can go to a shop and buy Cisco product, and obviously a lot of the big companies used it their products, because when they want to create a LAN or WAN or whatever, they're basically networking technologies that they need. All right, so that's the end of the video, and it's likely to take basically longer. So, but very quickly before we leave, I'm just going to show you their dividend safety for each one of these companies. So Home Depot is about 87% safety, very safe. Lowe's will be, I'll show you again, 93. CMI, which is Cummins, for example, is 98, and then Cisco, okay, is 91%. So again, all of these companies, their dividend is safe. There will be no cut coming up soon. Again, this is the kind of stocks that you should be looking at to diversify your basically overall portfolio. Don't just buy all the hypes. Include some of these boring companies that will pay you very good dividend, have been around a very long time, have amazing balance sheet, free cash flow, okay, and every quarter they actually give you more for your money. All right, so that's the kind of company that I'm looking for. I've owned all of these companies in my portfolio apart from Cisco. So Cisco is the only one that I don't own at the moment, so I'm looking forward to hopefully seeing a dip and buy in the dip, inshallah, see how that goes. If you lasted this long, okay, and you're still watching the video, please can I ask you to like the video, subscribe. If you find any value in this video, please share with your family and friends, okay, spread the word around. Thank you very much for watching. See you next time.